Let's discuss the tax treatment of employee achievement awards under the federal law in the United States. The Internal Revenue Service considers these awards to be recognition of service milestones or safety achievements rather than ordinary compensation. When handled correctly, such awards may be excluded from an employee's taxable income, providing both employers and employees with a benefit that honors workplace commitment while following the guidance set out in the tax code. Under IRS rules, employee achievement awards must be given as tangible personal property. This includes items like plaques, watches, or commemorative objects. Cash or anything that resembles cash, such as gift certificates, gift cards, or stored value coupons, does not qualify. Travel, vacation packages, tickets to sporting or entertainment events, meals, lodging, stocks, and other financial assets also fail to meet the criteria. The goal is to encourage employers to present a meaningful symbolic form of recognition, not a disguised form of income. For an award to be tax-free, it cannot be given under circumstances suggesting it is a substitute for pay. The award should be conferred during a ceremony or presentation, acknowledging the employee's service to the organization. The IRS generally requires that the award honor long-time service, such as at least 5 years of employment or a record of safety improvement. Safety awards cannot exclude lower-level employees in favor of management or admin staff. Awards should never favor highly compensated employees, and a written plan may be necessary to ensure fair distribution of recognition. In addition to the requirements on what can be given, there are dollar limits on how much can be excluded. For non-qualified awards, the total value excluded from an employee's taxable income cannot exceed $400 per year. If the award is part of a qualified plan, typically a documented non-discriminatory program, the exclusion can rise to $1,600. This higher limit requires that the average cost per recipient under all qualified plans not exceed $400. If an employee received both qualified and non-qualified awards in the same year, the total combined exclusion cannot exceed $1,600. These rules reflect a balanced approach to employee recognition. They permit organizations to celebrate years of dedicated service or proven safety outcomes without increasing taxable income. At the same time, the IRS ensures that such awards remain genuine symbols of appreciation and not convenient methods to bypass wage and compensation rules. In practice, employers must plan carefully. They should establish guidelines, document award policies, and track award values. This diligence protects both the organization and its employees. Employees receive honors that reflect their loyalty or safety efforts, while employers ensure compliance with tax laws. In sum, when implementing within the IRS criteria, employee achievement awards provide a valuable means to highlight the achievements of dedicated staff. By observing those standards, employees and employers can benefit from a more rewarding and compliant recognition program. So, let's go over the key facts again. IRS consideration of employee achievement awards. First, the IRS considers employee achievement awards as recognition of service milestones or safety achievement rather than ordinary compensation. Its specific criteria are met, these awards may be excluded from the employee's taxable income. You can see publication 15B, Employer's Tax Guide to Fringe Benefits for more information. Tangible personal property requirement. IRS rules specify that only tangible personal property qualifies for the exclusion. Cash equivalents, gift cards, gift coupons, gift certificates, unless they allow selection only from a pre-approved limited range of tangible items. Vacations, meals, lodging, tickets to events, and securities do not qualify. Items like plaques, watches, or similar commemorative objects do qualify. Again, see IRS publication 15-B. Non-disguised compensation and meaningful presentation. The award must be given under conditions and circumstances that do not suggest its substitute for wages. It should be presented as part of a meaningful ceremony or event, not simply included in pay. Length of service and safety requirements. Length of service. The IRS requires at least 5 years before an employee can receive a length of service award, except for a traditional retirement award. The employee must not have received another length of service award during the same year or the previous 4 years. Safety achievement. A safety achievement award cannot be disguised form of pay and cannot be given to managers, administrators, clerical employees, or other professional employees. It should encourage and reward frontline workers for maintaining safe work environments. No favoritism towards highly compensated employees. Awards cannot discriminate in favor of highly compensated employees, particularly if the employer wishes the award to be considered a qualified plan award with higher allowable exclusion limits. The dollar limits, again, non-qualified awards. If the award meets the criteria up to $400 per year, employee can be excluded. Qualifying plan awards up to $1,600 per year per employee can be excluded if it meets the qualified plan criteria, which is basically a written plan that does not favor highly compensated employees and adheres to specific non-discrimination rules. If an employee receives both the non-qualified award in the same year, the total combined exclusion cannot exceed 1,600. The 400 and 600, 1,600 limits cannot be stacked to exclude more than 1,600. The average cost of all awards under all qualified plans may not exceed the 400. So again, go to IRS publication 15B for more information.